Hi there, my name is Jason Ayers, Director of Business Development at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thanks for taking the time to watch our monthly review and commentary for June 2018. North American markets continue to climb a wall of worry with technology leading the charge. While this continues to be in line with our expectations, market volatility remains a consideration as headlines on trade, interest rates, and political unrest and instability in Europe cause short-term swings. These short-term swings have been an opportunity for us to capitalize on more expensive option premiums and to position our funds respectively in companies we want to own, trading at prices that we would consider to be a discount based on the underlying fundamentals. This approach of creating new positions on the lows and harvesting profits as stocks approach short-term highs continues for the month of June. May was a strong month for our equity growth fund, putting in a positive return of 2.67%, which was a little under the benchmark. However, the year-to-date return comes in at 4.54%, well above the benchmark, which sits at 0.25%. When asked about how market conditions influenced the equity growth fund, lead manager Alex Brandolini confirms that market volatility during the month was inconsistent with underlying economic fundamentals. Market pullbacks in a strong economic environment normally indicate a buying opportunity. As such, one notable trade executed was a bull put credit spread on the SPY, based on technical indicators suggesting that the ETF, which tracks the S&P 500, was oversold and ready for a bounce. This strategy generates cash flow as the ETF moves higher, but has another option position built in as a hedge. The objective was to enhance the fund's returns, but in a risk-managed way. Alex added that with the market cycle continuing to mature, it was also decided to shift the fund's exposures to companies with higher profitability and strong balance sheets. An example of our continued active management was the sale of our Disney position as the shares moved higher on the heels of its studio success, with the funds being allocated to the purchase of shares of Canadian Tire. Alex notes that both companies operate in the consumer discretionary sector and share similar characteristics of high return on equity, low leverage, and low earnings variability. In general, and in line with the firm's overall positioning, the fund remains overweight the tech sector while trimming positions which have moved higher to harvest profits. The income share class closed the month of May with a gain of 2.12%, beating the real world income index benchmark, which came in at 1.59%. This brings the year-to-date return to 1.52% compared to that of the benchmark at 0.08%. Consistent with our expectations and our overall approach, lead manager Mark McAdam notes that we continue to put cash in the income fund to work on market pullbacks. We've been actively using a put writing strategy to take positions in companies that have been on our radar. This approach was most recently used to take positions in BLK, MMC, and STX at depressed prices while capitalizing on the high implied volatility of the options market. This strategy generates cash flow for the fund and lowers the cost basis of the shares as we take positions in the underlying stock. In addition, part of an ongoing hedging strategy has been the purchase of put options on the S&P 500 ETF, SPY, as it approaches short-term highs. Puts increase in value as the underlying security sells off and as implied volatility increases. This helps offset some of the risk to the fund's holdings associated with a broader market sell-off. This position was closed out profitably on a market pullback driven by headlines around Italy. A new position was re-established as the S&P 500 approached its recent high. The fund continues to be overweight equities with a covered call strategy overlay. This is another approach used to generate cash flow as option premiums are attractive due to the day-to-day uncertainty. The option writing fund is managed to produce above average cash flow through the selling of option contracts. Both bullish and bearish strategies may be deployed depending upon market conditions. Not to be outdone, the option writing share class added 3.18% ahead of its benchmark, the MX Covered Call Writers Index, at 0.48%. Year to date, the fund sits at 1.09%, once again ahead of its benchmark, which remains negative 0.14% for the year. Lead manager Richard Croft had been focused on selling longer-dated options back in February to capitalize on significant increase in implied volatility and to bring in more upfront cash to help offset some of the market volatility at the time. With implied volatility and subsequently option premiums having contracted in recent weeks comparative to where they were in February, Richard has been taking shorter-term positions in the portfolio, more specifically in weekly close-to-the-money options. The typical approach as of late has been to sell these close to the money put options, options with strike prices close to where the stock is trading, and if assigned, take possession of the stock. Once the shares are purchased, a 1-week close to the money covered call is written. This strategy has been working well under current market conditions in helping to achieve the fund's objective, which is optimal cash flow. Regarding sector concentrations, for the past month, the fund has been overweight in the tech sector, mainly in the FANG stocks. The premiums are good, the options market is liquid, and the sector has been on firm ground as of late. The fund is underweight the banks, but may move back into that sector as the latest rate hike works its way through the economy. Our market expectations remain intact for the month of June. Headlines continue to drive short-term market volatility, but this is seen more as an opportunity based on the underlying fundamentals. We'll continue to build in hedges to offset a portion of the market risk. We feel increasing interest rates are already factored in as a headwind to the markets, and the overall economy is doing well. The wild card has been the imposition of tariffs and the risk of a trade war, which has the markets on its heels. No one really knows how far this will go and how significant the impact may be. It is possible that this is another one of Trump's bargaining tactics, and we don't believe that this will escalate to any significant levels. That said, we'll continue to evaluate and adjust as market conditions change.